My name is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. Joining me on this week's program, one of the fellow team members at Nelson Financial Planning, Kristin Castello, who's a Certified Financial Planner, Certified Financial Fiduciary, and a CPA. If you get another designation, it's going to just be too many letters. Okay, so
I think I'm tapped out.
You're tapped out. Well, still. Anyway, we're going to talk about a little bit about the importance of making sure that your retirement accounts really do have beneficiaries that are properly named. And we're going to go through a variety of points in this segment for our listeners, Kristin, and kind of talk about the problem, kind of bring it home with sort of a story or something that we've seen, and then ultimately what the solution is. I guess naming the right person is pretty important at the end of the day.
Yep. And I mean, we see this kind of all the time. So we'll kind of give you some client stories that we've seen and just give you from some perspective and some tips how to fix that for the future.
Yeah, and a lot of this comes actually from a Wall Street Journal article recently that sort of featured this discussion as well. So you certainly want to give them credit because they had a lot of good ideas that we wound up sort of incorporating into this segment of the podcast. So the reality is that one of the biggest issues is not necessarily paying attention to the forms. Look, these accounts all will have specific forms that are unique to that particular account provider, whether it's your 401k provider or your IRA custodian. And a lot of people would say, oh, well, I've got a will or I've got a trust or whatever the case may be. But it's those forms and completing them correctly on those accounts that actually will determine who inherits that IRA or that 401k. And a lot of people kind of miss that piece, if you will.
Yeah. They think that because they have a will sort of tucked away somewhere, that will dictate how the assets will flow. But that's not necessarily the case. So they're on these accounts. So if you have a 401k or an IRA, there's going to be a specific form from that company. So if you have multiple IRAs, they're going to have multiple different forms depending on the company. And so whatever you list there, that's going to be how the assets flow. So if you haven't updated that and you got a will afterwards, it's still going to go based upon what you initially wrote on these beneficiary forms.
Yeah, I mean, you often hear stories about how, post a divorce, an ex-spouse winds up inheriting something because the ex-spouse wasn't taken off or the new spouse added. We've certainly heard that story play out with respect to life insurance. And then there was one I think that you were dealing with as well, where this really came home to roost.
Yes. So it was this client. She had actually inherited quite a bit of money from a very, very distant relative. It wasn't even on her side of the family. It was on the other side. It was somebody she'd never met before, never really even heard of too much before.
Oh, wow.
But then she ended up inheriting quite a bit of assets and actually property too. But kind of thinking back to who she inherited it from, that may have not been the intent, know. So if there was just no beneficiaries listed and kind of going down the family line, that was one of the last living relatives.
Key takeaway on that part, obviously, is make sure you're reviewing and updating your beneficiary forms regularly. You've got to use those forms, particularly after major life events, to make sure that you are updating those forms on a regular basis to make sure that they reflect your current situation and what you actually want to happen. Because one of the things that folks sometimes do, and this doesn't work so well, is that they will name their estate as an heir. I think that's kind of one of the common mistakes that we see, where they just say, "Oh, well, the estate of the estate of John Smith," and just let it go to that.
Right. Because then that will eventually sort of follow the will, but it's a whole tax mess for your beneficiaries. So with these estates being the beneficiary, they don't have the same rules as individuals. So the estate is going to be its own entity, and they have different tax rules. So when it comes to inheriting retirement accounts, individuals have 10 years to liquidate that account, whereas an estate sometimes has 1 year, depending on who's holding it. So we actually saw this play out with one of our clients, and unfortunately, that was a huge tax bill. Pushed him up into the 32% bracket because he had to liquidate all of it all at once, versus if you were able to split it up over 10 years, probably would have been in the 22% bracket every year. So that's a permanent 10% of loss there that went off to taxes that unfortunately it could have been mitigated if the beneficiaries were designated correctly.
Yeah, I mean, obviously the key takeaway in that situation, Kristin, is it's best to name a person when you're setting up a beneficiary designation. It's always best to name a person, or you could also name a trust, so long as that trust was sort of set up to benefit a person as a beneficiary. The tax laws, the IRA tax laws, allow that to sort of look through to who is the ultimate beneficiary on a trust. But beyond that, if you name the estate or just leave it blank, then you wind up having much bigger issues.
Unfortunately, yes. And it's also more tax reporting, too, because the estate has its own tax return. So it's just another burden on the beneficiaries.
Yep. So then, in terms of other thoughts on this, the notion of adding in contingent beneficiaries all sort of goes hand in hand with what we're talking about here.
Yeah. So if you list a primary, this would be if something were to happen to both you and the primary beneficiary, your contingents would be the next in line to inherit the assets. So what we see quite a bit here is we have two spouses and then some kids, and the spouses will just leave each other as the primary beneficiary, not necessarily list any of the kids as contingent beneficiaries. And that doesn't necessarily work in the event that something unfortunately happens to both the parents.
Right.
Because then there's no listed beneficiaries. The kids would have to kind of go through probate to get the assets dispersed to them. So just having, contingent beneficiaries if you have kids, or just kind of listing somebody else in line that could potentially inherit the assets, that does help quite a bit.
Yeah, I mean, one of the cases that we saw, and this was probably a decade or so ago, because the other thing that happens when you name primary and contingent is it opens up the possibility of the primary beneficiary actually being able to disclaim the inheritance of that account and ultimately pass it to the contingent. So in this particular case, the spouse was named as primary, but fortunately what they had done is that they had named the three, I think it was three grandkids, the contingent beneficiaries. Now, so when the individual passed away, the spouse didn't really necessarily need that additional income that would have come from that. So because there was contingent beneficiaries named, she was able to disclaim and push that retirement account and the tax implications down to grandkids who were obviously in much, much lower tax brackets, and in this particular one, it was pre-2020. So now, you're talking about a lifetime of being able to have that asset compound itself over the course of these grandkids' lives, because they're still under the old rule, if you will.
Yeah, that is a very powerful option to have available for beneficiaries.
Certainly preserves it. So it gives you the opportunity, because if you don't name the contingent beneficiaries, then you don't get to do the disclaimer, because you can't disclaim to nobody. So that's another really good reason why you want to kind of name primary and contingent on these types of accounts. And then similarly, I guess when you're moving these accounts around, whether you do a rollover of an old 401k or whether you just kind of change custodians or change advisors, there's a whole new set of forms that you're going to need to do on that.
It doesn't transfer over your beneficiary information. So kind of going back to what we said about the first one, when you open an account, each account is going to have its own beneficiary forms. So if you have an account over here, an account over there, they're both going to have their own specific forms. So when you do a transfer or a rollover, you'll need to update the beneficiaries for that new company.
Yeah, something we always make sure that we do at the office anytime we're processing that kind of paperwork. We got a few more things to kind of chew through on this notion of making sure that you're naming the right beneficiaries on your retirement plans. So stay tuned with us through the break here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning.